what better mix than to, say where they would tell in terms of where the money should go, because they either invest or would bring in investment capital to an organization. And some of us finance guys have a say in how it gets spent eventually. So maybe Dominic, what in your aspect from a PE point of view, what would you say are the hot areas for infrastructure? And I'm being very open here given the backdrop of the 2 days that we have had here.
Sure, thank you. So, look, I think everything that's been spoken about earlier today are sort of the hot topics. There's a lot of capital that's going to be needed for 5G. Along with that, capital for fibre, capital for power, particularly if you're looking at developing markets, and capital for what might be considered more traditional towers businesses as markets leapfrog generations of technology where they perhaps haven't had access to even fibre in the past. So I think all of that is quite topical. Speaking from our own perspective, I think we're perhaps more interested in areas where there is, I guess, the intersection of growth, but also longevity of revenues. And so it's probably in technologies that are more established and better understood, but where just the demand for those things is going to increase because of the generational change in technology.
Carlos, maybe from a development point of view, where would you think is infrastructure most needed? Is it in fibre? Is it in towers? How is that mix in your mind?
Okay, thanks, Thivanka. I think over the last few years, everybody has thought about, at least our shareholders, which are the countries of the globe. Everybody has been talking about digital economy as being what will allow them to move from developing into developed economies, right? And what very few people have realized is that you don't have digital economy without the proper digital infrastructure in place. And I think that's kind of, finally, people are coming to that realization. So when you look at the infrastructure, digital infrastructure that needs to be put in place in the different economies, especially in emerging markets, right? What we have seen is that over the last few years, most of those countries have tried to bridge the digital divide using just wireless, right? However, because of the sheer increase in traffic volume, right? We know that it's not realistic to expect that data traffic to continue to go only wireless. So at some point in time, right, they need to invest more, not just in fiber, but also in data centers. And when I talk about fiber, it's not just the last mile, it's also backbone, inter and intra-city, right? So that the entire ecosystem will receive the investment needed, and that's something that we've been focusing on across the markets where we operate.
Yaniv, from an investment bank perspective, in terms of being able to attract capital for the organization, where do you see the interest? Because you have different spread or spectrum of investors. Where do you see this moving to, shifting towards to, given, like Carlos said, the 5G, the data throughput requirement, where does infrastructure get support from, in which aspect?
Yeah, so just speaking on Carlos' definition of digital economy, whether it's what's available today around devices and video, and what's coming, data analytics, AR, VR, video, games, we believe that we're just starting in terms of understanding the quantum of data that needs to be transmitted within to enable that digital economy. Just as an example, zooming on data center space, in the past, the Amazons and the Alibaba cloud of the world, we used to have orders of 2 to 5 megawatts type of rollouts. Last year it became 2050, and now these guys are starting data center farms of 200 megawatts. So there's just an explosion amount of data which needs to be transmitted appropriately. The three components of the digital infrastructure, data centers, towers, and fiber, are at the moment at probably all-time peak demand, but also supply of capital. Whether it's public markets where you see valuations at all-time high across the three sectors, or private markets which can enable massive deals, such as we have seen a $15 billion take private of Zayo, which is the fiber business in the US. There's news about the third largest data center company going private for $15 billion Cyrus One. Just enormous amount of money is chasing those opportunities. Investors are differentiating between those three verticals around what's the longevity of a revenue stream, technology obsolescence risk, ROIs, replacement cycles, and so on. But in a sense, there is enough capital to fund those. It just varies across the three verticals and across geographies, which we'll talk about in a few minutes.
If you look at our business, EDOTCO, we are in the tower space, we're in literally leasing of space on sites, right? Now, Dominic, maybe I'll ask you, given that TPG is the operator of some of the infrastructure assets as well, what is your view of the tower industry moving into semi-active or the active space? Because if you look at the discussions we have had earlier, the shareability, the cost economics that need to come in, sharing comes in, and how do you possibly optimize the active space as well? Any views on that?
Sure. So I mean, if you go back to the whole reason the so-called tower industry came into existence, and maybe at some point we'll stop calling it the tower industry, but it was because it was more economic for everyone involved to share a tower than it was to build them for each operator. And people got comfortable because that was probably whilst a very important piece of the infrastructure, the least proprietary to the operators that were using them. So whether or not tower companies then move into active infrastructure, I think is partly going to be a function of people's comfort on the customer side to do that, but partly also perhaps economic necessity. So when we're talking about things like small sites and street furniture, if there is no practical way, I mean, you don't need 3 bus stations in one place, you need one. And so it seems logical that everyone should share that, and it's probably economically best for everyone to share that. It's certainly the best for the environment. But I think where the capital that's behind traditional tower companies usually thinks in terms of it as being a reasonably predictable revenue stream with no risk of technology obsolescence. And when you start to introduce more active components of the network into that business, the way I think we would look at it is to say, okay, now we're introducing some technology obsolescence risk, but by sharing that infrastructure and monetizing it more quickly, am I going to get that investment back before I face that obsolescence risk? And I think that's the kind of win that a tower company, if you like, would be looking for. And on the flip side, we understand that operators will be looking for access to a particular location and being able to share more cost effectively than going in alone.
Thanks. Carlos, I understand IFC is invested in Red, but Amrish was speaking of where, it's in Mexico where shareable infrastructure is something. Could you possibly share some views on that?
Sure. So Amrish mentioned 2 companies that IFC is a shareholder, right? C Squared in Africa and Head Compartida in Mexico. And I think the rationale behind those investments is because we have been, for the longest time, believers in shared infrastructure, right? Especially when it comes to emerging markets, we know that I agree with what Yaniv mentioned, that today there is enough capital, or there is a lot of capital available for financing networks around the globe. But when we look at some of the emerging markets, especially the riskier ones, right? Whether it's because of macroeconomic situation, because of regulatory issues, or just because it's a market that is kind of unknown to some of the investors, the amount of capital that is available is not necessarily there. Sometimes there is capital, but not enough to be deployed in an efficient way to generate enough competition and drive quality of services and prices. So in some of those markets, it makes a lot of sense, right? In most markets, it makes a lot of sense not to duplicate networks. And that's what we have tried to encourage in both markets. Those are C-squared and Rede Compartida were driven by different reasons, right? For instance, in the case of Mexico, it is a market where, despite several players, several mobile operators, right, the market was still dominated by América Móviles, right? Not just on the mobile side, but also in the access, in the infrastructure side. So Rede Compartida was established as kind of an alternative, right, to allow the market to be more competitive in light of the dominant position played by América Móviles, right? In the case of C-squared, it has much more to do with providing the backbone, providing the fiber that is needed to allow a more efficient and cheaper service to be provided to the carrier. So that is a wholesale type of business, right?
Thanks. Dominic, if you look at in terms of risk versus rewards, right? So you get the emerging markets, the developed markets, and whilst you have steady cash flows and better returns possibly in the developed markets, the emerging markets offer significant growth perspective and opportunity. But what's that balance of risk versus ROI, how we balance that as an institution?
Yeah, look, I think it all depends on the investor base that you serve. So I think when some people hear infrastructure investors, they're thinking steady long-term cash flows, probably spread across a number of countries or a number of customers, so that those cash flows are fairly predictable. At the other end of the spectrum, and the pool of money that I spend my time investing from, it's a traditional private equity pool of money, and I invest in multiple industries, and so we're benchmarking our so-called infrastructure investments against other private equity opportunities. So it's a higher return that we require, and therefore we're more naturally drawn either to developing markets or developed markets, where there's a particularly high growth opportunity that's still going to get us the returns that we need. So in developed markets, it might be things like small sites, if we're convinced that technology obsolescence risk that I was talking about earlier is sort of a solvable problem. But in developing markets, we don't need to take that risk. Instead, we're doing things like traditional towers businesses, where the growth opportunity outweighs some of the other risks for us.
Yaniv, would you have an opinion on this?
I generally agree with Dominic. It's the tower economics on a per tower basis in many cases you could kind of derive to the same cash flow profile, but what is more challenging in emerging markets typically is the cost of capital, which is a byproduct of foreign exchange risk, CPI risk, and country risk. And these are typically in emerging markets will be higher than developed market. For achieving kind of a status quo type of valuation for those cash flows or those towers, you gotta be able to compensate with a much higher growth rate, which some of the emerging markets, particularly in this part of the world, do present that. When you don't have that growth, then inherently the math, in a way, will translate to a lower value or lower ROI for an emerging versus developed market play.
Yeah. Carlos, I'll ask the question in a slightly different manner from you, given from the IFC. So, developing markets does bring its risk that comes with the growth benefits that you can see, and you can lead from technology and actually get things ahead. But also I understand as a development bank, you do support developing emerging frontier market countries rather than developed markets. And this brings about, how do we as a corporate, as a business looking to protect its shareholders, look to mitigate that risk exposure that comes with the developing, emerging frontier markets kind of scenario? Any, aspect on or any view from your point of view?
Okay, I think you touched on a couple of points that are critical, right? I mean, I think the opportunity to leapfrog technologies is something that has been proven in many of the emerging markets, right? If we just see, for instance, what mobile telephony was able to do in Africa, right, in a much shorter period of time compared to the development of the sector in the so-called developed markets, I think that's an evidence of this technology leapfrog that is possible in emerging markets. Of course, that opportunity comes with a risk, right? And risk means that investors will require a higher return. And I think in today's markets, where we can still see in some of the, let's say, subsectors of digital infrastructure, decent returns in developed markets. Okay? Developing markets end up facing competition in terms of where the capital is going to be deployed. Okay? Just as an anecdote, a few months ago, I had a meeting with this international data center company, right? And they were telling me, hey, I think IFC will get very excited to know that we have finally made the decision to move into emerging markets. And I'm like, wow, that's great, that's fantastic. Which market are you going to move into, right? I was expecting them to tell me, I don't know, Indonesia, right? Vietnam, and when the guy said, oh, we are going into South Korea. And like, wow, if South Korea is emerging market, right, to you, we are really talking about very different things, right? So I think that's one of the challenges that we still face when it comes to investing in emerging markets.
Yaniv, I'll take this up with you. As a company, we want growth, right? And we want that to have the return on investment, appropriate return on investment. There's two ways to do this. Either you start on a, clean sheet of paper, Greenfield, or you go down the route of M&A. In terms of what accretes more value to shareholders, say in the public domain, what is the balance or the fine art in managing this two areas for growth?
Yeah, buy versus build, very topical. In an environment like we are today, where interest rates are where they are and the abundance of capital is so significant, then traditionally M&A is a lot more visible. And we are seeing it, some of the transactions that I've mentioned and many others which have happened and will happen. So that's what drives companies like yourselves and others to be a little bit more aggressive. As cycle of economy and interest rates and cost of capital will progress and become closer to historical levels, we will see that dynamic shift, and the rationale for M&A versus build will be low. And we're not there yet, but it may or may not come in the next 1 or 2 years. Now, some of the dynamics today drives, for example, you have companies who trade at very high attractive valuations. They can go and buy in the public market at a cheaper valuation just because of the economies of scale element, and then the public markets will reward them with the higher valuation just for the merit of doing the transaction. That's kind of reality today, but it's not something that will sustain a correction in cost of capital dynamics.
Dominic?
Yeah, I'd probably see it a little more as a strategic question than a cost of capital question or an access to capital question. The reason I say that is that it's true that M&A activity picks up when there's capital available and when cost of capital drops. But from the perspective of a business, particularly in infrastructure business, usually there is an advantage to scale. Could be an advantage in the way people value you. It could be an advantage in your cost structure, or both. And so if we're trying to back or build the best business that we possibly can, the question we're asking is, how do we get it to be a scale business? Generally speaking, it's going to be cheaper to build than it is to buy, but we're always looking at that chessboard and trying to figure out, look, if someone else gets that scale advantage before us, you know, that's a disadvantaged position that we don't want to be in. So no black and white answer, I'm afraid.
That's okay. You know, if you look at 5G, right? So we you know, 3G was a mega hype. Spectrum was sold at incredible sums across the world on auctions, whatnot. 4G comes along, and best thing since sliced bread became 5G all of a sudden, and it's not even out. And you can hear the repetition of what the industry has been talking of. In your mind, Carlos, how do you see 5G impacting the infrastructure space? You know, in terms of how we try and capitalize and not make the mistakes that was done in the 3G era, where, you know, a lot of the investments, some of the MNOs had to write off. Where do you see, from infrastructure point of view, where you feel 5G could, you know, be more appropriate for the developing markets?
You know, unfortunately, I think 5G is still a few years away from emerging markets. I mean, we've heard some of them kind of being more bullish about introducing it sooner than others, right? But I think there are still, I mean, many of the markets that we talk about, right, have barely started 4G, okay? So maybe they will be able to leapfrog technologies and introduce 5G sooner, but I think that is still to be seen. You mentioned spectrum, okay? And when we talk about the amount of money that was paid in the past for spectrum, brings another issue that many of our clients face and still struggle when it comes to emerging markets, which is regulatory risk, okay? And that is something that cannot be, you know, taken lightly in many of the markets where we operate. And that is actually one of the reasons why many of our clients come to talk to us, because of the experience that we bring after 60 years of operating in emerging markets, the fact that we are part of the World Bank and all of that, right? But one thing that we have also come to realize is that, yes, regulatory risk is meaningful in many markets where sometimes the governments see the telecom sector as a kind of a piggy bank, okay? But oftentimes it's also because there is a lack of capacity in the parts of some of those regulators, right? So oftentimes there is an education process that needs to be done, and I think this is something that we have been investing a lot in terms of partnerships with some of those regulators. So it's kind of a long answer to a very direct question, Thivanka, but I would say that when it comes to 5G in emerging markets, I would still kind of wait to see how they will roll out some of the 4G networks that have just started before we start worrying so much on that.
Carlos, just to follow up on that particular aspect, you're saying 5G is possibly ahead of the curve for this part of the region of developing markets. How about data centers, edge computing, and all this talk? I mean, we haven't got basic digital infrastructure out there. You know, and people are talking about edge computing and robotics and all that. What's your view? Again, is this a little bit too ahead of time for this part of the world, or what?
It's happening already, okay? So we can't say that emerging markets are insulated from all this technology innovation that is going on around the world, right? I think the scale probably hasn't come in the same level that we have seen in some of the other markets, but it's just a matter of time. However, for instance, if we look, okay, let's look at some of those markets, right? Many of them are still just starting when it comes to shared infrastructure. some of those markets, let's say Bangladesh, okay, the regulation for independent tower companies was issued there only last year. And of the 4 licenses that were issued, you guys are the only ones who are operating, right? There are pretty much no data centers in Bangladesh, and you're talking about a market that when you look at demographics, when you look at the size of the population, young population, technology savvy, right? I mean, it should be already kind of booming, right? And yet, okay, we still see it in the early stages of where some of the other markets have already reached. Okay.
Interesting. Dominic, I think you kind of touched on this earlier, because if you look at 5G, right, in terms of investment and in terms of the attractiveness in this part of the world, it is, as pointed out already, possibly a little bit ahead of time. But when we're looking to invest ahead, then would we look to see where appropriately we can invest, for the future technology without ending up with obsolescence and having to write off huge, amounts of money eventually?
Yeah, I mean, a lot has been said today about the 5G transition. I worry less about when that's going to happen, because from the perspective of investing in infrastructure, the sooner the better, because, as we've all talked about, it's going to create a lot more demand for the various kinds of infrastructure that we want to invest in, and it's going to create a lot more of that growth that we find attractive. But that's from the perspective of infrastructure that doesn't have so much risk of technology obsolescence. On the other side of the fence, people who put money in 3G and 4G want to see a return on that investment. I think there was a good chart up earlier in the day for those who didn't see it. The punchline was basically, 2G's paid for itself, 3G might have paid for itself, and 4G definitely hasn't. I think that's probably doubly true for markets that have leapt a generation in technology, and their first opportunity to monetize is perhaps with 3G or 4G technology. They haven't had the benefit of cash coming back to them from their older 2G operations. So, when somebody in a given market breaks ranks and moves to the next generation of technology, good for the infrastructure companies, question for the operators, and I suppose, on balance, I hope people don't rush into it. I don't know that the consumers or users will necessarily demand it, because it's only once they see other people or other businesses in their markets using those services that demand will start to take off. They're not necessarily thinking I'm using a 4G phone or a 5G phone or a 3G phone. They're just saying my YouTube video won't play. And so I think it's much more about the user experience and whether someone sitting next to them is having a better experience.
Yeah.
Yeah.
No, I think everything at the end of the day will interlink in some shape or form. So first, to Dominic's point, there is still question mark around how the mobile network operators will make money out of 5G. Mobile gaming, autonomous vehicles, Internet of Things are all great prospects, but they're not making money today. When they do, that's going to drive a tremendous amount of requirement for that 5G infrastructure. That's one element to it. How the MNOs can operate, can manage that dynamic is share more. So we think about tower, fiber, and data centers that are the father of sharing economy. Today you have people sharing cars and bicycles and umbrellas, but everything started actually from this industry, where a tower initially was the first sharing economy model. And when the economics of 5G are difficult, challenging, unclear, naturally the MNOs will be more open for sharing infrastructure. And if you think about what China did ahead of 5G, they told the 3 telecom operators, please, let's create one infrastructure. So far on the tower side only, but remains to be seen how deep they will go into that. And regulatory will drive, or may drive, more of that happening in other places around the world, especially in emerging economies. There's different views whether you need 5G rollouts in Indonesia 5 or 10 years from now, or maybe you just need one, and who knows what kind of steps the regulator will take towards that. That's one side of it. The second side, what 5G is going to do is going to even create a little bit less clarity around data center 5G and towers. In a way, the ultimate edge computing solution is going to mean every tower will be effectively a small data center. As the computing power needs to be closer to the handset, for again, it's uses like gaming and augmented and virtual reality. There are some ideas that you could create a mini tower, a mini data center in every tower. So that's one convergence. The second one is data-heavy small sets or towers in general on the 5G have to be fiberized to be able to support that throughput. So that's tower and fiber converged. So we are seeing a number of attempts by the three verticals to start eating into the other verticals, and maybe you'll see our players do all three over time, be it regulatory driven or not.
Great. We just have a little bit of time, but I think in closing, right, I mean, if you look at the fixed line industry, it's hit its S-curve, and mobile industry has gone through the OTT play and walled garden scenarios, and they're becoming a utility as just like any other commodity that's out there. But the tower space, we're trying to evolve as much as we can. You can see the American towers, SBA, etc. They're all moving into small cell, fiber, differentiating their services so that they stay relevant in the technology evolution that's there. So, Carlos, maybe in closing, how do you think we should look to keep ourselves relevant and focused to cater to the new evolution in technology and what the needs of the customer are as well, and actually whether the customer is going to be MNO or someone else?
Okay, Thivanka, we have been investing in the telecom sectors since 1970, right? And when it comes to return that we've had in our investments in the sector, right, across all the different industries that IFC has invested, I can tell you that telecoms rank at the top.
Brilliant.
Okay, so we are still very bullish and very confident, right, that there is a very promising future for this sector in emerging markets. Okay. Having said that, yes, we talked about convergence, as Yaniv mentioned, right? There is this convergence of data centers, fiber, tower companies, right? Everything. But we are also starting to see, right? Converge, for instance, distributed generation power companies, okay, is starting to look into data centers, right? So I think this, what we are about to witness, really kind of a new business model, okay, that will eventually have the ability to provide networks more efficient, most cost-efficient networks, better quality services, right, which are, at the end of the day, the key elements when it comes to providing services in emerging markets.
Thank you. Dominic, something in closing?
Yeah, I think the sort of question of where do you draw the line between operator and infrastructure provider is perhaps not one I can answer. But if I could draw an analogy of the electricity industry, and I think there it's sort of been concluded that generation is best shared, transmission is best shared, distribution is best shared. But when it comes to touching the customer, that's where people compete. Now, unfortunately, in electricity, there's not really very much you can do to differentiate at the customer end, except perhaps on price and packaging for the particular customer. So I think the question for infrastructure providers is how do you appeal to your customers at whatever layer of that value chain that they're better off sharing than not. And then at the other end, for the operators, it's, how do you position yourself so that you've got something to offer the consumer of your product other than just price. Now, I think we're a long way from moving that, sharing very close to the customer. We're really, using the electricity analogy, we're at the generation point of that, if you like. But I think it's going to shift, and that's the very, very long-term question to answer.
Yaniv, any last comments?
No, I covered that mostly in the previous answer, but at the end of the day, this will be a lot of technology-driven, application-driven, and what your customers, you as an infrastructure provider, what your customers will be asking and what the consumer demand on the app side will be requiring.
Carlos, Yaniv, Dominic, thank you very much. Ladies and gentlemen, a warm round of welcome. Thank you.
Ladies and gentlemen, you've been very, very patient. I've just got a few words I'd like to say. I was asked, could I sum up what's happened this afternoon? Well, we've talked about a lot of things. I thought the thing to do is, when Suresh started, he talked about the common themes. Do 4G well, 5G requires change in structure and attitudes. We need collaboration. MNOs, governments, regulators, and the wider ecosystem. Early access to locations. Unbundling of the industry. Shared solutions. He actually called it the shared infrastructure. But what we heard from one of his customers was intelligent, shareable infrastructure. And then with the final panel today, what I think we heard there was the investment community understands this, and they can see for the various different markets there is a support there. So I think we can probably, I feel from what we've heard today, and it's up to you whether you agree, but I think everything we've heard today supports what Suresh said at the beginning. So, final thing is you now urge your cocktail. The cocktail is on the 6th floor, so please go up there, and there is signage